Alright, before we dive into the secrets of Texas auto insurance, a quick but important disclaimer. This presentation is for informational and educational purposes only and should not be considered financial or legal advice. I am not a licensed insurance agent or financial advisor. The sole purpose of this video is to arm you with knowledge, to help you understand the system, so you can ask smarter questions and make informed decisions when you speak with a qualified, licensed professional. My goal is to empower you, not to advise you. Now let's talk about your money. Two drivers. Let's call them Bill and Ted. They live in the Houston area. They both drive a 2020 Toyota Camry. They have identical, perfectly clean driving records. Not a single ticket or accident between them. Yet, Bill is paying over $900 a year more for his car insurance than Ted is. How is that possible? It's not a mistake. It's not bad luck. It's because Bill lives in zip code 77083, and Ted lives just a few miles away in 77450. And that one tiny detail is costing Bill almost $100 a month. That sounds insane. Get ready, because that's just the tip of the iceberg. You felt it, right? You get that renewal notice in your email, you open it up, and your heart sinks a little. The price went up. Again. For no reason. You didn't get a ticket. You didn't have an accident. Your car is a year older, so it's worth less. So why on earth are you being asked to pay more? Feels like a scam. It feels like you're trapped in a system with rules you don't understand, designed to take as much of your money as possible. Well, today that ends. In this video, I am pulling back the curtain on the entire Texas auto insurance industry. I'm not just going to give you a few generic tips like shop around or ask for discounts. That's beginner stuff. I'm going to give you the playbook. I'm going to show you the key factors, the ones the insurance companies really care about, that determine your rate. You will learn why your premium is so high, and you will get a step-by-step framework for systematically lowering it, without sacrificing the critical protection you and your family need. By the end of this presentation, you will no longer be a victim of random price hikes. You will be in control. To do that, we need to understand what I call the Texas insurance matrix. It's a web of factors, and the first, most fundamental piece of this puzzle is something most people get dangerously wrong: your liability coverage. Everyone in Texas knows you have to have insurance. It's the law, but the law only sets the absolute bare minimum you need to legally drive on the road. And this is the first trap so many people fall into. They think, I'll just get the state minimum. It's the cheapest option, right? Wrong. It is the single most financially catastrophic mistake a driver can make. The Texas state minimum liability coverage is what's known as a 30/60/25 policy. Let's break down what those numbers actually mean in the real world, because they are terrifyingly small. The first number, 30, stands for $30,000. That is the maximum amount your insurance company will pay for a single person's medical bills if you cause an accident. One person, $30,000. Now, have you seen a hospital bill lately? A single night in the ER after a minor collision with an ambulance ride and a few diagnostic scans can easily blow past $30,000. If that person needs surgery, ongoing physical therapy, you are personally on the hook for every single dollar above that 30 grand. The second number, 60, stands for $60,000. That's the maximum total your policy will pay for all medical bills for everyone in the other car, combined. So, if you hit a minivan with a family of 4 inside, and they all need medical attention, your insurance provides a grand total of $60,000 to be split between them. It's nothing. A single serious injury could wipe that out instantly, leaving the others with nothing from your policy. And the last number, 25, is maybe the scariest of all. That's $25,000. That is the maximum your insurance will pay for all property damage you cause. And that doesn't just mean the other car. It means everything you damage. Let's play this out. You're driving down the highway, you look down at your phone for a split second, and you rear-end the car in front of you. That car happens to be a brand new Ford F-150 King Ranch. The average price of that truck is over $70,000. Your policy covers $25,000. Who pays the remaining $45,000 to fix or replace that truck? You do. Out of your own pocket. What if you don't just hit the truck? What if you swerve and take out a city light pole or a guardrail? That damage also comes out of that same $25,000. If you can't write a check for the difference, what do you think happens? The other party's insurance company isn't just going to forget about it. They will sue you, and they will win. And then they will come for everything you own and everything you will ever own. They can put a lien on your house. They can garnish your wages, taking a chunk of your paycheck every single week for years, or even decades. They can seize the money in your savings account. Your entire financial future wiped out over one bad moment in a cheap insurance policy. Now you're probably thinking, this doesn't sound like a video about getting affordable insurance. It sounds like you're telling me to spend more money. And this is where we get to the first big secret. Protecting yourself with much better coverage is shockingly inexpensive. The price jump from the state minimum 30/60/25 to a much safer 100/300/100 policy. That's $100,000 per person, $300,000 per accident, and $100,000 for property damage, is often just a few dollars a month. It is, without a doubt, the single best bang for your buck purchase in the entire world of insurance. You are buying hundreds of thousands of dollars in lawsuit protection for the price of a couple of coffees. But here's the kicker. Here's the part the insurance companies don't advertise. When you choose more than the state minimum, you are sending them a powerful signal. Insurance is a game of risk. And in their eyes, drivers who willingly choose the bare minimum, get out of a ticket level of coverage are statistically a higher risk. They see that choice as a red flag. Conversely, when you choose higher liability limits, you are flagging yourself as a more responsible, lower-risk client. You're telling them, I have assets to protect. I am a serious person who doesn't take stupid risks. Over time, this can actually lead to better overall rates and access to more discounts. You look like a better customer to them, and they are more inclined to treat you that way. So, the first step to finding affordable insurance isn't about finding the cheapest plan. It's about finding the smartest plan. It's about building a foundation of liability that protects you from financial ruin for just a few extra dollars a month. This one decision is the bedrock of a solid, yet affordable insurance strategy. We've just covered how to protect yourself from devastating lawsuits and financial ruin. But what about your own vehicle? What happens when you need to get your car fixed? That's where the next layer of the Texas Insurance Matrix comes in: collision and comprehensive coverage. And in the next part, we are going to dive deep into what these actually cover, and I'll reveal the simple calculation you can do to figure out if you are completely wasting your money paying for them. Let's start with a scenario. Picture this: you're driving your trusty Toyota Camry, maybe a few years old, down the Katy Freeway in Houston during rush hour. Traffic is a nightmare, moving in that stuttering stop-and-go rhythm that we all know and hate. You're focused, keeping a safe distance, but the driver behind you is a little too interested in their phone. Suddenly, you hear that gut-wrenching screech of tires, followed by a jolt that shoves you forward. You've been rear-ended. Your neck hurts, your heart is pounding, but after you make sure everyone is okay, your first thought is, my car. The bumper is crumpled, a taillight is shattered. Who pays for this? If the other driver is at fault and has insurance, their policy should cover your repairs. But what if they don't have insurance? What if they have the bare minimum state coverage that isn't enough? What if it's a hit and run? Or let's flip the script. What if you were the one who got distracted for a split second and accidentally bumped into the car in front of you? That's where collision coverage becomes your financial superhero. Collision coverage is exactly what it sounds like. It pays to repair or replace your own car if it's damaged in a collision with another object. That object is usually another vehicle, but it could also be a tree, a guardrail, a light pole, you name it. It doesn't matter who is at fault. If you cause the accident, collision coverage fixes your car. If someone else hits you and they're uninsured or underinsured, collision coverage fixes your car. It is your safety net for the physical integrity of your vehicle in an accident. Now, before you get too excited, there's a catch. It's called the deductible. The deductible is the amount of money you have to pay out of your own pocket for a repair before the insurance company pays a single dime. Think of it as your skin in the game. Deductibles typically range from $250 to $2,000. A higher deductible means you pay a lower monthly or semi-annual premium, because you're agreeing to take on more of the financial risk yourself. A lower deductible means a higher premium, because the insurance company is on the hook for more of the cost. So in our Houston freeway scenario, let's say the damage to your Camry is $3,000, and you have a $500 collision deductible. You would pay the body shop the first $500, and your insurance company would then pay the remaining $2,500. If the damage was only $400, you wouldn't file a claim at all, because the cost of repair is less than your deductible. Now let's shift gears. Imagine it's a few months later. Your Camry is all fixed up, looking good as new. You park it outside your apartment in Dallas one evening. Overnight, a classic Texas thunderstorm rolls in. Not just rain, but that terrifying golf ball-sized hail that sounds like the sky is falling. The next morning, you walk out to a car that looks like the surface of the moon. It's covered in dozens of dents and dings. This wasn't a collision. You didn't hit anything. So what now? This is where comprehensive coverage steps in. Comprehensive is sometimes called other than collision coverage, and that's the best way to think about it. It covers damage to your car from a whole list of unfortunate events that are not a collision. We're talking about things like theft, vandalism, fire, falling objects like a tree branch, and those notorious Texas weather events. Hail, flooding, and even hitting a deer on a back road near San Antonio. Just like collision, comprehensive coverage also has a deductible that you have to pay first. So, collision covers you when your car hits something. Comprehensive covers you for almost everything else. Together, they are often bundled and sold as full coverage. This is the coverage that protects the actual value of your car. But here's the multi-thousand-dollar question. Do you actually need it? And this brings us to that simple calculation I promised. This is the part where you can potentially save hundreds if not thousands of dollars a year. Get ready to do some simple math. The big insurance companies don't really advertise this, but there's a point where paying for collision and comprehensive becomes a bad financial bet. I call it the 10% rule. Here's how it works. First, you need to know the actual cash value or ACV of your car. This isn't what you paid for it. It's what it's worth today with its current mileage and condition. The easiest way to get a good estimate is to go to a website like Kelley Blue Book or Edmunds and enter your car's information. Be honest about the condition. Let's go back to our example. Your Toyota Camry is, let's say, 10 years old. You look it up and its private party value is about $5,000. That's step 1. Step 2. Look at your insurance policy declaration page. Find the line items for collision and comprehensive coverage. You need to know how much you are paying for just those two coverages per year. Don't look at the total bill, which includes liability and other things we'll talk about later. Let's say your $500 deductible collision coverage costs you $400 a year, and your $500 deductible comprehensive costs you $200 a year. That's a total of $600 annually. Now for step 3, the calculation. The 10% rule states that if your annual premium for collision and comprehensive is more than 10% of your car's actual cash value, you should seriously consider dropping the coverage. In our example, your car is worth $5,000. 10% of that is $500. You are currently paying $600 per year. According to this rule, you are overpaying. You are paying more for the insurance than the risk is statistically worth. Let's think about why this makes sense. If you get into a major accident and your car is totaled, the absolute maximum the insurance company will pay you is the car's value minus your deductible. In this case, that's $5,000 minus your $500 deductible, which equals $4,500. So, you are paying $600 a year to protect a potential payout of $4,500. You're essentially paying $1 for every $7.50 of potential coverage. As the car gets older and its value continues to drop, that ratio gets worse and worse. Next year, the car might be worth $4,200, but your premium will likely stay around the same. Now you're paying $600 to protect a potential $3,700. The core idea here is self-insurance. By dropping the coverage on an older, lower-value car, you are betting on yourself. You take that $600 you would have paid to the insurance company and you put it in a savings account, a dedicated car repair or replacement fund. After 1 year, you have $600. After 2 years, $1,200. After 3, $1,800. If you get into an accident and need to repair or replace your $5,000 car, you've already saved up a significant chunk of that money yourself. You are managing your own risk instead of paying a company to do it for you. But, and this is a very important but, this rule is not for everyone. There are 2 critical situations where you absolutely should not drop this coverage no matter what the math says. First, if you have a loan on your car or you are leasing it, the lender or leasing company technically owns the vehicle until you pay it off. They have a financial interest to protect, and they will almost universally require you to maintain both collision and comprehensive coverage. If you drop it, you'll be in violation of your loan agreement, and they can actually buy a policy on your behalf at a ridiculously high price and force you to pay for it. So, if you have a car payment, you need full coverage. End of story. Second, and this is the most important personal finance question you have to ask yourself. If your car were totaled tomorrow, could you afford to repair or replace it out of your own pocket without it causing a major financial crisis? If the answer is no, then you probably need to keep the coverage. That $5,000 Camry might not seem like much, But if it's your only way to get to work, and you don't have $5,000 in savings to buy another one, then paying that $600 premium is a necessary expense. It's buying you peace of mind and protecting your ability to earn a living. So the 10% rule is a powerful guideline, but it's for people who own their car outright and have a healthy emergency fund. It's for people who can afford to take on that calculated risk. For them, it can be a brilliant way to cut a major expense from their budget. So your homework is this. Find your most recent insurance statement and look up your car's value. Do the math. Are you paying more than 10%? The answer might surprise you. You could be throwing away money on a policy that no longer makes financial sense for you. Now that you understand how to protect the value of your car, we need to talk about protecting something infinitely more valuable: everything else you own. Your savings, your home, your future earnings. Because the basic liability insurance that Texas requires is shockingly low. And a single mistake behind the wheel could lead to a lawsuit that financially ruins you for life. There's a ticking time bomb on most people's policies, hiding in plain sight. And in the next part, we're going to expose it, and I'll show you exactly how to adjust your liability limits to make sure you are truly protected. So let's talk about that ticking time bomb. It's called liability coverage. And the way it works is actually pretty simple. If you cause an accident, liability coverage is the part of your policy that pays for the other person's damages. It pays for their medical bills, their lost wages, their pain and suffering. It pays to repair or replace their car. It is not for you. It is for them. It's the coverage that protects you from being sued into oblivion. Now, every state has a minimum amount of liability coverage that you are legally required to carry to drive on the road. In Texas, that minimum is what we call 30/60/25. You've probably seen these numbers on your policy, but you might not know what they actually mean. Let's break it down because this is the heart of the problem. The first number, 30, stands for $30,000. That is the maximum amount your insurance company will pay for any single person's bodily injuries in an accident that you cause. One person gets hurt, the most your policy pays for their medical bills is $30,000. The second number, 60, stands for $60,000. That's the maximum total amount your policy will pay for bodily injuries for everyone in the other car, combined. So if you hit a car with 3 people in it, the absolute most your insurance will pay out for all of their medical bills put together is $60,000. And that last number, 25, stands for $25,000. That's the maximum your policy will pay for all property damage you cause in an accident. This is almost always the other person's car. But it could also be a mailbox, a fence, or a storefront. 30/60/25. That is the legal minimum in Texas. And here's the terrifying truth. Millions of Texans are driving around with exactly this level of coverage, thinking they're protected. They are not. They are one minor mistake away from financial ruin. This isn't an insurance policy. It's a legal permission slip to drive, and it's a trap. Let's start with that property damage limit. $25,000. That might have been enough to replace a car 20 years ago. Today, it's a joke. According to Kelley Blue Book, the average price of a new car in the United States is over $48,000. The average price of a new truck is over $60,000. Do you see the problem here? Let's play this out. You're driving home from work, you glance down at your phone for just a second, and you rear end a brand new Ford F-150. It's not even a bad accident, but the tailgate is crumpled, the bumper is shot, the parking sensors are destroyed. The repair bill comes back at $35,000. Your policy pays the first $25,000. And then what? The other driver's insurance company isn't just going to forgive the remaining $10,000. They are going to come after you for it. Personally. They will send you a bill, and if you don't pay, they will sue you, they will get a judgment against you, and they will garnish your wages until it's paid off. You just inherited a $10,000 debt because you tried to save a few bucks a month on your car insurance. And that's a relatively minor accident. What if you swerve to miss a deer and you take out a Tesla Model S? That's a $100,000 car. You are now personally on the hook for $75,000. What if you hit a plumbing van full of expensive equipment? Or cause a chain reaction on the freeway involving 3 other cars? That $25,000 limit is a financial landmine. But as scary as that is, it's nothing compared to the bodily injury limits. $30,000 per person, $60,000 per accident. This is where lives are truly destroyed. Have you ever seen a hospital bill? A single ambulance ride can cost over $2,000. One night in the hospital can be $5,000. A simple surgery for a broken arm can easily top $20,000 or $30,000 once you factor in the surgeon, the anesthesiologist, and the facility fees. And we haven't even talked about physical therapy, rehabilitation, or lost wages from being unable to work. So let's imagine another scenario. You run a stop sign you didn't see. You T-bone another car. The driver, a 40-year-old construction worker, breaks his leg. He needs surgery with plates and screws, a hospital stay, and months of physical therapy. He can't work for half a year. His total medical bills come to $70,000. His lost wages are another $30,000. The total claim against you is $100,000. Your state minimum policy covers $30,000 of it. You are now personally responsible for the other $70,000. And trust me, they will come for it. They will sue you for everything you have. They will go after your savings account, your investments, your house. They can put a lien on your property. They can garnish your wages for years, maybe even decades. Every paycheck you get, a piece of it will be gone before you even see it, all because of one mistake in an insurance policy that was designed to fail. This is the ticking time bomb. It's the belief that having insurance means you're safe, when in reality, having the state minimum is like trying to stop a house fire with a water pistol. It's a false sense of security that will evaporate the second you actually need it. So, how do you defuse the bomb? It's actually shockingly simple and affordable. You need to raise your liability limits. And not just by a little bit. I recommend, as a bare minimum for most people, limits of $100/300/100. Let's look at what that means. $100,000 for bodily injury per person. $300,000 for bodily injury per accident. $100,000 for property damage. Look at the difference. With a $100,000 property damage limit, you can total almost any vehicle on the road and be completely covered. You're no longer sweating every time you see a Mercedes or a BMW in front of you. With $100,000 per person and $300,000 per accident for bodily injury, you have a powerful shield against the vast majority of injury claims. You're protected from that broken leg scenario, a serious back injury, or an accident involving multiple people. This isn't just car insurance. This is asset protection. This is future income protection. Now I know what you're thinking. That sounds great, but it must cost a fortune. I can barely afford my insurance now. And this is the most important secret I can share with you. The price difference between dangerously low state minimum coverage and truly protective coverage is almost always laughably small. You might think that tripling your coverage would triple your price. Doesn't work that way. The jump from 30/60/25 to 100/300/100 might only cost you an extra $10 to $20 a month. Sometimes even less. Why is it so cheap? Because risk isn't linear for insurance companies. The biggest risk for them is that first dollar of coverage. The chance that you'll have a claim is their biggest exposure. The chance that your claim will exceed $30,000 is much smaller. The chance it will exceed $100,000 is smaller still. So, for them to sell you that extra layer of protection from $30,000 up to $100,000, it costs them very little in projected risk. It's like buying in bulk. The first item is the most expensive, but each additional one costs pennies. For the price of a few fancy coffees a month, you can buy yourself hundreds of thousands of dollars in real financial security. There is no better return on investment for your peace of mind. And for those of you who have a bit more to protect, a house with some equity, a retirement account, a decent income, you should go one step further and ask about an umbrella policy. An umbrella policy is an extra layer of liability protection, typically sold in increments of $1 million, that sits on top of your auto and home insurance. If you cause a catastrophic accident and the lawsuit exceeds your auto limits of, say, $300,000, your umbrella policy kicks in and covers the rest, up to $1 million or more. These policies are the single best bargain in the insurance industry, often costing just a few $100s a year for $1 million in coverage. So your homework after watching this is to pull out your own insurance policy. Find the declaration page and look for those three numbers. If you see 30/60/25, you need to call your agent or company immediately and get a quote to raise them. Don't ask them what they recommend. Tell them you want to see a quote for 100/300/100. The peace of mind you'll get is worth every single penny. We've just spent all this time talking about how to protect yourself from lawsuits when you hurt someone else or damage their property. But we've completely ignored a massive piece of the puzzle. What happens when your own car gets wrecked? What happens when a massive Texas hailstorm turns your brand new truck into a golf ball? Or when a driver with no insurance plows into you and then speeds off. Most people assume, I have full coverage, I'm fine. But full coverage isn't a real insurance term. And a simple mistake in two other key coverages on your policy can leave you with a totaled car, a massive loan to pay off, and absolutely no money from the insurance company to fix it. We'll break down exactly what those are and how to make sure you're truly covered in the next part. So let's talk about that nightmare scenario. You've just bought a beautiful new-to-you car. You have a loan on it for, say, $25,000. You've been making payments for a year, so you still owe $22,000. You've got your state minimum liability insurance just like the law requires. Then, one rainy Texas afternoon, you hydroplane on I-35, spin out, and hit a guardrail. You're okay, thankfully, but the car is completely mangled. The tow truck driver takes one look and says, yeah, that's a total loss. You call your insurance company, file the claim, and a few days later the adjuster calls you back. The news is bad. They've determined the actual cash value of your car, what it was worth the second before the crash, is only $18,000. They're very sorry, but since you only had liability coverage, and this was a single car accident where you were at fault, your policy covers $0 of the damage to your own vehicle. Zero. So now you have no car. You still owe the bank $22,000 for a vehicle that now exists only as a pile of scrap metal. And you have to somehow find the money to buy another car just to get to work. This is the financial trap that ensnares thousands of people every single year. It's a devastating, life-altering event. And it's entirely preventable with two key coverages: collision and comprehensive. Let's start with collision. This one is pretty straightforward. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, a tree, a guardrail, a light pole, you name it. It doesn't matter who was at fault. Because the accident, collision has your back. If someone else causes it and they have no insurance or not enough, collision can step in to get your car fixed quickly while your insurance company fights to get the money back from the other driver. You'll have to pay your deductible, which is the amount you agreed to pay out of pocket before insurance kicks in. We'll talk more about deductibles later, but paying a $500 or $1,000 deductible is infinitely better than paying $18,000 for a new car. If you have a loan on your car or if you're leasing it, the bank or leasing company will almost certainly require you to carry collision coverage. They have a financial interest in that vehicle, and they want to make sure their investment is protected. But even if you own your car outright, if you can't afford to just go out and write a check for a new one tomorrow, you need collision coverage. Next up is comprehensive coverage, sometimes called other than collision. This is the coverage that protects you from all the weird, unpredictable things life and Texas can throw at your car. Think of it as the act of God coverage. A hailstorm rolls through and your car looks like a golf ball? That's comprehensive. A deer decides to play chicken with you on a farm-to-market road? Comprehensive. Your car gets stolen from the mall parking lot? Comprehensive. A tree branch falls on it during a thunderstorm, it gets flooded during a hurricane, someone vandalizes it, a rock cracks your windshield on the highway. All of these are handled by your comprehensive coverage. Just like with collision, you'll have a deductible. But again, look at the risks here in Texas. We are the #1 state for hail damage claims. We have hurricanes and flash floods. We have a massive deer population. Without comprehensive coverage, any one of these common events could leave you with thousands of dollars in repair bills, or a completely totaled car that you have to pay to replace all by yourself. Now, when you hear a friend or an insurance agent talk about having full coverage, this is what they mean. Full coverage isn't an actual type of policy you can buy. It's just a common phrase that means a policy includes liability, collision, and comprehensive. It's the holy trinity of auto insurance that protects you from damaging others and protects your own vehicle from damage. But even with full coverage, there's still a gap. Let's go back to our original nightmare scenario. You owed $22,000 on the loan, but the car was only worth $18,000. Even if you had collision coverage, the insurance company would only pay out the actual cash value, the $18,000 minus your deductible. You'd still be on the hook for that extra $4,000 that you owe the bank. You'd be paying $4,000 for a car you can no longer drive. This is called being upside down, or having negative equity in your loan, and it's incredibly common, especially in the first few years of a loan when your car's value depreciates faster than you can pay the loan down. This is where a magical and often very cheap coverage comes into play: gap insurance. GAP stands for Guaranteed Asset Protection. It does exactly what its name implies. It covers the gap between what your car is worth and what you still owe on your loan. In our example, gap insurance would have paid that $4,000 difference to the bank, completely wiping out your remaining loan balance. You'd walk away with no car, but also no debt, free and clear to start fresh. If you are financing a vehicle, especially with a small down payment, you absolutely must ask about gap insurance. You can often get it through the dealership or your auto lender, but it's almost always cheaper to add it directly to your auto insurance policy. We're talking a few extra dollars a month to protect yourself from thousands in potential debt. Okay, so we've protected your assets from your own mistakes and from acts of God. But what about the other guy? What happens when someone else crashes into you, and it's clearly their fault? Their liability insurance should pay for your car repairs and your medical bills, right? Well, yes, in a perfect world. But we live in Texas, which has one of the highest rates of uninsured drivers in the entire country. It's estimated that 1 in every 8 drivers on the road with you right now has no insurance at all. This is where uninsured and underinsured motorist coverage, or UM/UIM, becomes one of the most important things you can have on your policy. Let's say one of those uninsured drivers runs a red light and T-bones you. Your car is wrecked and you have a broken arm. If you don't have uninsured motorist coverage, you are in for a world of hurt. You'd have to sue the other driver personally to get any money, and let's be honest, if they couldn't afford insurance, they probably don't have assets for you to collect. So you're stuck. Your collision coverage could fix your car, but what about your medical bills? Your lost wages from being unable to work? Your pain and suffering? That's on you. Uninsured motorist coverage steps in and acts like the insurance the other driver should have had. It pays for your medical bills, your lost wages, and your car repairs if you don't have collision. Underinsured motorist is similar. It kicks in when the at-fault driver has insurance, but their liability limits aren't high enough to cover all of your bills. They might only have the state minimum $30,000 for injuries, but your hospital stay costs $50,000. Underinsured motorist coverage would pay that remaining $20,000. Do not skip this coverage. It protects you and your family from irresponsible people. Finally, there's one more crucial piece of the puzzle, and it's a big one here in Texas. Personal injury protection, or PIP. PIP is fantastic. It covers medical expenses and a percentage of lost wages for you and anyone in your car who is injured in an accident, regardless of who is at fault. If you get rear-ended, PIP can start paying your doctor's bills immediately, so you don't have to wait for the other person's insurance company to accept liability, which can take weeks or months. Because the accident, your own PIP covers you. It's no-fault medical coverage. Here's the critical thing to know. In Texas, by law, every auto policy sold must include at least $2,500 of PIP coverage, unless you specifically reject it in writing. Some agents might try to save you a few bucks a month by having you sign that rejection form, but in most cases, this is a terrible idea. The value you get from PIP far outweighs its small cost. It's immediate access to medical care without worrying about deductibles from your health insurance, and it covers things your health insurance won't, like lost wages. So now you see, a truly protective insurance policy is so much more than just the state-required liability. It's a suite of coverages, collision, comprehensive, gap, uninsured motorist, and PIP that work together to form a financial fortress around you and your vehicle. But knowing what these coverages are is only half the battle. The other half is choosing the right limits and deductibles. How much coverage is enough? How much is too much? Picking the wrong numbers here is where people either waste a fortune on insurance they don't need, or leave themselves dangerously exposed, thinking they're covered when they're not. Getting that balance wrong can be just as financially devastating as not having the coverage at all. We'll break down exactly what those numbers mean, and how to choose the perfect limits for your specific situation in the next part. Let's crack the code on those insurance numbers. When you see a policy, especially in Texas, you'll see 3 numbers separated by slashes like 30/60/25. This isn't some secret agent password. It's the blueprint for your financial survival after a crash. And the state minimum of 30/60/25 is, to be blunt, a financial trap waiting to spring. Let's break it down piece by piece. The first number, that 30, stands for $30,000. This is your bodily injury liability limit per person. This is the absolute maximum your insurance company will pay for the medical bills of any one person you injure in an accident where you are at fault. $30,000. A few years ago, that might have sounded like a reasonable amount of money. Today, it's a rounding error in a serious medical event. Imagine a simple, everyday scenario. You're trying to merge onto the LBJ freeway, you look over your shoulder for a split second too long, and you bump the car in front of you. Doesn't even seem that bad. But the driver of the other car gets a nasty case of whiplash. They're not faking it. Their neck and back are in legitimate pain. So what happens next? First, the ambulance ride. In a major Texas city, that can easily be $2,000 before they've even rolled you through the emergency room doors. Then the ER visit itself, the doctors, the nurses, the facility fee, that's another several thousand. They'll want an MRI to check for serious damage. Cha-ching, add another $2,000 or $3,000. Now they need physical therapy, maybe a chiropractor for the next few months. That's a few $100s a week. And what about their lost wages? If they can't work for a month because of the injury you caused, and they make a modest salary, you're on the hook for that too. Add it all up. The ambulance, the ER, the scans, the therapy, the lost income. You can burn through $30,000 so fast it will make your head spin. And if their injuries are any more severe, a broken bone, a concussion, that $30,000 limit is gone before the first bill even arrives in the mail. Anything above that, it doesn't just disappear. It becomes your personal problem. Comes out of your pocket. Now let's look at the second number, the 60. This is your bodily injury liability limit per accident. This is the absolute maximum your policy will pay out for all injuries combined, no matter how many people you hurt in a single crash. So, if you hit a car carrying a family of 3, your insurance has a total pot of $60,000 to split among them. But remember, they will never pay more than $30,000 to any one of them. Let's play this out. You run a red light and T-bone a minivan. Mom, the driver, breaks her arm and needs surgery. Her medical bills hit $40,000. Your insurance pays the first $30,000, because that's your per-person limit. The other $10,000? That's on you. Now, Dad in the passenger seat has severe bruising and a concussion. His bills are $20,000. Your insurance has $30,000 left in its $60,000 pot for this accident, so it covers his bill completely. The teenager in the back has minor injuries, let's say $5,000 in bills. The insurance covers that too. So, in total, your insurance paid $30,000 for Mom, $20,000 for Dad, and $5,000 for the son. That's $55,000. It's under your $60,000 total limit. But you are still personally on the hook for the extra $10,000 for Mom's surgery because she blew past the per-person limit. You see how this gets complicated and expensive fast? And that was a relatively mild family accident. What if it was a 4-car pileup on I-10? What if 6 or 7 people are injured? That $60,000 limit will be a distant memory, and the lawsuits will start flying directly at you. Finally, we have the third number, the 25. This is your property damage liability limit. It's the maximum your insurance will pay for any property you damage in an accident. Usually, this means the other person's car. And just like with medical costs, $25,000 is a dangerously low number in today's world. Think about the cars you see every single day in Texas. A new Ford F-150, the most popular vehicle in the state, can easily cost $60,000, $70,000, even $80,000. You rear-end one of those. It might not look totaled, but modern vehicles are packed with technology. You crack a bumper? You're not just replacing plastic. You're replacing sensors, cameras, and radar systems that have to be professionally recalibrated. A new LED headlight assembly on a luxury SUV can cost over $2,000. A simple fender bender can now easily run up a $15,000 or $20,000 repair bill. What if you hit a slightly nicer car? A Lexus, a BMW, a Tesla? The repair bill for a minor collision with a high-end vehicle will obliterate your $25,000 limit. And if you total it, you've just bought yourself a 5-figure lawsuit. And it's not just cars. Property damage covers anything you hit. A brick mailbox, a custom-built fence, a city light pole, a storefront. You get the idea. That $25,000 limit is a joke. So why do these ridiculously low limits even exist? Because it's the absolute legal minimum required to operate a vehicle in the state of Texas. Think of it this way. The state minimum isn't designed to protect you. It's designed to provide a tiny token amount of protection for the people you might hit. It's a starting line, not a finish line. Relying on state minimum coverage is like showing up to a hurricane with a cocktail umbrella. You're technically prepared according to some obscure rule, but you are going to get wiped out. So what's the solution? You have to raise your limits. Instead of 30/60/25, you should be looking at a minimum of 100/300/100. Let's translate that. $100,000 for a single person's injuries, $300,000 total for all injuries in an accident, and $100,000 for property damage. This is the level where you start to have real meaningful protection. And I know what you're thinking. That sounds expensive. My premium is going to skyrocket. And that is the single biggest misconception in auto insurance. The jump in premium from dangerously low state minimums to a robust protective policy is shockingly small. We're often talking about the price of a couple of pizzas or a streaming subscription per month. For an extra $20, $30, maybe $40 a month, you can increase your coverage by hundreds of thousands of dollars. There is no other purchase you can make in your life that provides that much financial leverage and peace of mind for such a small cost. Because here's the terrifying truth they don't tell you when you just click the cheapest option. When the damages you cause exceed your policy limits, the other party doesn't just shrug and walk away. Their insurance company and their lawyers will come after you. Personally, they will look at everything you own and everything you earn. Do you have a savings account? They can go after it. Do you own a home? They can put a lien on it. Do you have a steady job? They can get a court order to garnish your wages, taking a chunk of your paycheck every single week until the debt is paid. A single mistake on the road, a moment of distraction, could lead to a decade or more of financial servitude. All because you tried to save $15 a month on your car insurance. Think of a guy named David. He's a young electrician, works hard, and just bought his first new-to-him truck. He's trying to be responsible, so he gets his own insurance policy. To keep costs down, he goes with the state minimum 30/60/25. One rainy evening, he hydroplanes on the loop and slides into a brand new Mercedes. The driver of the Mercedes needs back surgery, and the car is totaled. The total damages? About $80,000 in medical bills and $70,000 for the car, for a grand total of $150,000. David's insurance policy dutifully pays out its maximum, $30,000 for the injuries and $25,000 for the car, a total of $55,000. That leaves a $95,000 gap. And that $95,000 is now David's personal debt. He spent the next 7 years with his wages garnished, his dream of buying a house completely gone, all to pay for a mistake that a proper insurance policy would have handled with a single check. Your liability limits are not just numbers on a page. They are a shield. They stand between your life as you know it and complete financial ruin. This is the single most important decision you will make on your policy, and it's the one place you absolutely cannot afford to be cheap. So now you're protected if you cause the accident. But what happens if it's the other way around? What happens when you're the one sitting at a red light and you get rear-ended by someone who has no insurance at all, or worse, someone who just drives away? It's a completely different kind of financial nightmare. And here in Texas, it happens every single day. We'll dive into how you build a fortress around yourself to protect against those drivers in the next part. So let's talk about that fortress. Let's talk about the single most important, most frequently overlooked, and most financially devastating mistake people make with their Texas auto insurance. We're talking about the ghost on the highway, the driver who hits you and either has zero insurance or worse, just speeds away, leaving you on the side of the road with a wrecked car, a throbbing headache, and a financial black hole opening up in front of you. In Texas, this isn't a rare one-in-a-million scenario. It's a terrifyingly common reality. Statistics show that roughly 1 out of every 8 drivers sharing the road with you in the Lone Star State is driving illegally without any insurance. 1 in 8. Look around you in traffic next time. For every 8 cars you see, one of them represents a potential financial catastrophe for you and your family if they make a mistake. They have no safety net. If they hit you, their insurance company is them. And chances are, if they can't afford insurance, they certainly can't afford your $100,000 medical bills or the $25,000 it'll take to replace your SUV. This is where your fortress comes in. It's called uninsured and underinsured motorist coverage. Let's call it UM/UIM for short. This is not for the other guy. This is for you. It is coverage you buy to protect yourself from the irresponsibility of others. It's the single most powerful tool. You have to shield your family from financial ruin after an accident that isn't even your fault. Let's break it down because there are 2 critical parts to this shield. First, you have uninsured motorist bodily injury, or UMBI. This is the big one. Imagine you're stopped at a red light in San Antonio, and someone plows into the back of your car. Your neck is injured, your spouse has a broken arm, and the other driver gets out, mumbles an apology, and admits they let their insurance lapse. They have nothing. Your health insurance might cover some of the initial hospital visit, but what about the deductibles? The co-pays? What about the months of physical therapy you now need? What about the wages you lose because you can't go back to your construction job for 6 weeks? What about the pain and suffering, the disruption to your entire life? That is exactly what UMBI is for. It steps into the shoes of the uninsured driver and pays for your and your passengers' medical expenses, lost wages, and even pain and suffering, up to the limits you select. It's your own insurance company defending you from the financial fallout of someone else's mistake. Without it, you're on your own. You could try to sue the other driver personally, but as the old saying goes, you can't get blood from a stone. You'll spend thousands on a lawyer to chase a person who has no assets, and you'll end up with nothing but a legal bill. UMBI is your direct line to financial recovery. Then there's the second part, uninsured motorist property damage, or UMPD. This one is simpler. It helps pay to repair or replace your car if it's damaged by an uninsured driver. Now in Texas, this coverage comes with a mandatory $250 deductible. So if you have a $5,000 repair bill from a hit and run in the grocery store parking lot, you'd pay the first $250, and your UMPD coverage would handle the remaining $4,750. You might be thinking, wait, doesn't my collision coverage do the same thing? And you're right, it does. If you have collision, it will also repair your car regardless of who is at fault, and you'll just pay your collision deductible, which might be $500 or $1,000. Because of this overlap, many people with collision coverage choose to skip UMPD. However, if you're trying to save money and you don't have collision coverage on an older vehicle, having UMPD is an incredibly cheap way to get a layer of protection against the most likely source of damage, other drivers. But we're not done. There's a silent U in there that's just as important. Underinsured motorist coverage. This is the sneakiest threat of all. The other driver did follow the law. They have insurance. The problem is they only have the Texas state minimum liability coverage, which, as we discussed, is a laughably low $30,000 per person for bodily injury. Let's play that out. You're in a serious accident on the Dallas North Tollway. It's clearly the other driver's fault. Your medical bills from the surgery and hospital stay alone are $80,000. The other driver's insurance company happily cuts you a check for $30,000. That's all they're legally required to pay. That's the maximum on the policy. So what about the other $50,000? Without underinsured motorist coverage, that $50,000 is now your problem. It's coming out of your savings, your retirement, or it's going to a collections agency. But if you have underinsured motorist coverage, your own insurance company steps in and covers that gap. If you had, say, $100,000 in UIM coverage, it would pay that remaining $50,000 medical bill, and you would be made whole. It fills the gap between the other driver's pathetic coverage and your actual costs. It's the ultimate safety net. Now here is the most important thing I am going to tell you in this entire series. In Texas, insurance companies are legally required to offer you UM/UIM coverage. However, you can reject it. To do so, you have to physically sign a waiver, a piece of paper that explicitly states you are declining this protection. Every single day, people walk into an insurance agent's office, or they're on a website clicking boxes, and in an effort to shave $10 or $15 off their monthly bill, they sign this waiver. They sign away their single greatest protection against financial ruin. Think about what that signature means. You are betting that you will never be hit by one of the millions of uninsured or underinsured drivers in Texas. You are betting your house, your savings, and your family's future on the hope that the person who runs a red light and puts you in the hospital was responsible enough to buy more than the bare minimum insurance. That is a terrible bet to make in this state. The cost of UM/UIM coverage is almost always a tiny fraction of your total premium, yet it provides a monumental amount of protection. We're talking about the price of a couple of coffees a month to protect yourself from a potential $500,000 lawsuit's worth of medical bills. The return on investment is astronomical. So here is your homework. Right now, after this video, I want you to go find your own auto insurance policy. Log into the app or pull out the paper document. Look for the section that lists your coverages. Find the lines that say uninsured/underinsured motorist bodily injury, UM/UIMBI, and uninsured/underinsured motorist property damage, UMPD. First, make sure it's there. If you see it's been rejected or waived, your number one priority is to call your agent and add it immediately. Today. Do not wait. Second, look at the limits. A common rule of thumb, and a very good one, is to match your UM/UIM limits to your own bodily injury liability limits. If you have 100/300 liability coverage to protect others, you should have 100/300 UM/UIM coverage to protect yourself. It begs a very simple question. Why would you ever value a stranger's health more than your own? Why would you buy a $100,000 safety net for someone you might hit, but only a $30,000 safety net for your own family if someone else hits you? It makes no sense. Match your limits. Protect your own family with the same fervor you're legally required to protect a stranger. This coverage is the bedrock of a smart auto insurance policy in Texas. It's not a luxury add-on. It's a non-negotiable necessity. It's the difference between an accident being a painful inconvenience and an accident being the single event that derails your entire life. So you've built the outer walls of your fortress. You're protected from the financial attacks of other drivers. But what happens in a more common scenario? A minor fender bender, a confusing intersection where fault is unclear, or an accident where you are the one at fault. Who pays for your doctor's visit or your passenger's ambulance ride right away, without waiting for a lengthy fault investigation? There's another layer to this fortress, a crucial one that provides immediate, no-fault medical coverage. It's called personal injury protection, or PIP, and in Texas, it works in a very specific and powerful way that can save you a fortune. We'll break down exactly how in the next part. So, what exactly is personal injury protection, and why is it your secret weapon in the Texas insurance game? Think of it as your financial first responder. PIP is a type of no-fault coverage, and that term no fault is the key to its power. In the chaotic, stressful moments after a car accident, the last thing you want to do is start a long, drawn-out battle over who was to blame. Normally, if someone else hits you, you have to wait for their liability insurance to investigate, accept fault, and then eventually pay your medical bills. This process can take weeks, months, or even longer. Meanwhile, the hospital wants its money. Your doctor wants their money. And you're stuck in the middle in pain and watching the bills pile up. PIP completely bypasses that nightmare scenario. Because it's no fault, it pays out for your medical expenses and other costs regardless of who caused the accident. Even if you were 100% at fault, your PIP coverage kicks in immediately to help you. It's your insurance for you and your passengers, designed to provide instant financial relief so you can focus on what actually matters: your recovery. Now, here's the uniquely powerful part about PIP in Texas. The state of Texas recognizes how fundamentally important this coverage is. So much so, that under Texas law, every single auto insurance policy sold in the state must include personal injury protection. Insurers are legally required to offer it to you. You don't have to ask for it, you don't have to know the secret handshake. It is automatically included in your quote. In fact, if you want to remove it from your policy, you can't just tell your agent over the phone. You have to formally reject it in writing. The state has set up a system where the default option is to protect you. You have to take a deliberate physical action to opt out of this safety net. That should tell you everything you need to know about how critical this coverage is. So what does it actually cover? This is where it gets even better. It's not just a basic medical plan. The minimum PIP coverage in Texas is $2,500, but you can, and often should, purchase more. This coverage applies to you, the policyholder, and any passengers in your vehicle at the time of the accident. First, it covers medical expenses. This includes the ambulance ride, emergency room fees, hospital bills, surgery, x-rays, and even follow-up care like physical therapy or chiropractic visits. And unlike your health insurance, there are typically no networks to worry about and often no deductible to meet. The money is just there to pay the bills. But here's the game changer, the part that separates PIP from almost any other coverage and can literally save you from financial ruin. It also covers up to 80% of your lost wages. Let that sink in. If an accident leaves you unable to work for 2 weeks, 2 months, or even longer, PIP will pay you a significant portion of the income you're losing. Your regular health insurance will never do that. Your health plan might pay for the doctor, but it won't pay your rent. It won't buy your groceries. It won't keep the lights on while you recover. PIP does. And it doesn't stop there. If your injuries are so severe that you can't perform essential household duties, like caring for your children or maintaining your home, PIP can help pay for services to get those things done. It provides a comprehensive shield against the cascading financial consequences of an injury. Let's make this real. Imagine a woman named Maria. She's a freelance graphic designer in Dallas, a single mom with a 10-year-old son. Her income depends entirely on her ability to work. One afternoon, while driving on the Central Expressway, she's rear-ended in a chain reaction crash. It wasn't her fault, but the situation is messy with multiple cars involved. At the scene, she feels shaken but okay. The next morning, She wakes up with debilitating back pain and a severe headache. The doctor diagnoses a concussion and serious whiplash. He tells her she needs to rest, no screen time, and regular physical therapy. She can't work. Now let's look at two versions of Maria's story. In version A, Maria had rejected PIP in writing to save $12 a month on her premium. She has a high-deductible health insurance plan, so the first $6,000 of her medical bills are her responsibility. The ER visit, the MRI, and the first few weeks of physical therapy easily eat that up. She's now $6,000 in debt, and the bills are still coming. Worse, she has no income. Her clients are understanding, but their projects can't wait. She's losing work every day. She spends hours on the phone with the at-fault driver's insurance adjuster, who is questioning the severity of her injuries and delaying payment. The stress is overwhelming. Within a month, she's drained her savings and is borrowing money from family just to pay her rent. Her recovery is stalled because the financial anxiety is making everything worse. Now let's rewind to version B. Maria kept the standard PIP coverage on her policy. The day after the accident, she calls her own insurance company. She explains what happened. There's no argument, no debate about fault. They immediately begin covering her medical bills. The hospital sends the bill to them, not her. The physical therapist is paid directly. Her $6,000 health insurance deductible is never even touched. Then she submits proof of her recent income, and her PIP coverage starts sending her checks for 80% of what she would have been earning. The financial pressure is gone. Instead of fighting with adjusters, she's focused on her physical therapy. Instead of worrying about eviction, she's able to rest and recover as her doctor ordered. That $12 a month she spent on PIP didn't just buy insurance. It bought her peace of mind. Bought her stability. It allowed her to heal without her entire life collapsing around her. That's the power of PIP. People often think, well, I have good health insurance, I don't need it. But as we saw, that's a dangerous assumption. Your health insurance has deductibles, co-pays, and co-insurance that can leave you with thousands in out-of-pocket costs. It has restrictive networks that might not include the specialist you need to see. And most importantly, it does absolutely nothing to replace your lost income. PIP fills all of these critical gaps. Another common thought is, if someone else hits me, I'll just sue them for my lost wages and medical bills. And while that's an option, it's a terrible first line of defense. Lawsuits are incredibly slow, taking years to resolve. They are expensive, requiring lawyer fees that take a huge chunk of any settlement. And there's no guarantee you'll win. PIP is immediate. It's certain. It's the money you need when you need it without having to step foot in a courtroom. When you're getting a quote, you'll see the minimum $2,500 offered. For many, that's enough to cover the copays and deductible for a minor incident. But I urge you to ask for quotes with higher limits. $5,000, $000, or even $10,000. Often, doubling your coverage costs just a few extra dollars per month, but it provides a much more substantial safety net if you ever face a serious injury. It's one of the most cost-effective upgrades you can make to your policy. So when you're hunting for that affordable Texas auto insurance, don't look at PIP as an optional expense to be cut. Look at it as the foundation of your own financial protection. It's the coverage that protects your health and your wealth simultaneously. Rejecting it to save a few bucks is like removing the airbags from your car to save a little weight. It might feel fine every day you don't crash, but on the one day you do, you'll regret it profoundly. This no-fault, immediate protection is absolutely essential, but it primarily covers your own injuries. What happens when the person who hits you is one of the millions of drivers with no insurance, or not enough insurance, to cover the catastrophic damage they just caused to your car and your body? This scenario is terrifyingly common, and it's why we need to talk about the two coverages that act as your shield against the irresponsible drivers all around us. These two coverages are called uninsured and underinsured motorist protection, often abbreviated as UM/UIM. And I'm going to be blunt. In the state of Texas, driving without this coverage is one of the biggest financial gambles you can possibly take. Let's break down why. First, let's talk about the uninsured part of the equation. This is the most straightforward. An uninsured driver, someone breaking the law by driving with no liability insurance whatsoever, slams into you and you're injured. Who pays for your medical bills? Who pays for your lost wages while you recover? Who compensates you for the pain and suffering of a broken leg or a severe concussion? It's not the other driver. They have no insurance, and the odds are incredibly high that if they can't afford a basic insurance policy, They don't have tens of thousands of dollars in assets for you to sue for. This is where your uninsured motorist bodily injury coverage, or UMBI, becomes your financial lifesaver. It steps into the shoes of the insurance the other driver should have had. It pays for your medical expenses, your physical therapy, your lost income, and even damages for pain and suffering, up to the limits you select. Think about it. You're driving home from work, stopped at a red light, and you get rear-ended by someone texting and driving. The impact is severe. You're rushed to the hospital with a herniated disc in your neck. The diagnosis? You'll need ongoing treatment, maybe even surgery, and you'll be out of work for months. The bills start piling up. The ambulance ride, the emergency room, the MRI, the specialist visits. We're talking $10,000, $20,000, $50,000 in the blink of an eye. If the driver who hit you is one of the estimated 1 in 8 Texas drivers who are uninsured, you would be facing that mountain of debt completely on your own. But if you have UMBI coverage, your own insurance company steps in and covers those costs for you. It's a shield that protects your health, your savings, and your family's future from someone else's recklessness. Now there's a second part to this. Uninsured motorist property damage, or UMPD. This is designed to repair or replace your car if it's damaged by an uninsured driver. In Texas, this coverage is a bit different. It typically comes with a standard, non-negotiable $250 deductible. If an uninsured driver totals your $20,000 SUV, you pay your $250 deductible, and your insurance company pays to fix or replace your vehicle. Now you might be thinking, wait, I already have collision coverage for that. And you're right, you could use your collision coverage. But your collision deductible is likely much higher, $500, $1,000, or even $2,000. Using your UMPD saves you money on the deductible. It's a small but important piece of the puzzle that ensures you're out as little cash as possible when you are 0% at fault. But here's where things get truly critical. This is the part that most people misunderstand, and it's arguably the more dangerous threat on the road today. That's the underinsured motorist. The underinsured driver is the person who did the bare minimum. They bought the cheapest possible insurance policy to be legally compliant, which in Texas means they have liability limits of $30,000 for bodily injury per person, $60,000 per accident, and $25,000 for property damage. We call this 30/60/25. Sounds like a lot of money until it's not. Let me paint you a picture. Let's call her Maria. Maria is a 35-year-old graphic designer in Austin. She's driving her 3-year-old Toyota RAV4, a car she's incredibly proud of, on her way to a client meeting. She enters an intersection on a green light. A pickup truck runs the red light at high speed and T-bones her driver's side door. The crash is violent. Firefighters have to use the jaws of life to get her out. She's airlifted to the hospital with a shattered pelvis, a fractured femur, and internal injuries. Her car, worth about $28,000, is a mangled wreck. It's a total loss. The driver of the pickup truck is clearly at fault. The police report confirms it. And good news, he has insurance. He has the Texas state minimum, 30/60/25. Let's look at the numbers. The at-fault driver's property damage liability limit is $25,000. Maria's car was worth $28,000. So right off the bat, his insurance pays out the max of $25,000, leaving Maria $3,000 short on replacing her vehicle. It's frustrating, but that's the smallest of her problems. Maria's medical journey is just beginning. She has 2 major surgeries. She spends weeks in the hospital, followed by months in a rehabilitation facility learning to walk again. She can't work. The medical bills are astronomical. The airlift, the surgeries, the hospital stay, the specialists, the ongoing physical therapy. The grand total comes to $210,000. On top of that, she's lost 6 months of income, which amounts to another $40,000. Her total economic damages, just the hard numbers, not even counting the immense pain and suffering, are $250,000. Now remember that at-fault driver's insurance? His bodily injury liability limit is $30,000 per person. That is the absolute maximum his insurance company will pay toward Maria's injuries. $30,000. Maria is facing a $250,000 financial catastrophe, and the person who caused it can only provide $30,000 of coverage. This leaves a gap of $220,000. Where does that money come from? Without the right coverage, it comes from her. It comes from her savings account, her retirement fund, selling her home, or declaring bankruptcy. Her life is permanently altered physically and financially because someone else made a catastrophic mistake and was carrying an inadequate amount of insurance. This is the exact scenario that underinsured motorist UIM coverage was designed to prevent. If Maria had UIM coverage on her own policy with limits of, say, $250,000, her own insurance company would step in to bridge that terrifying gap. The other driver's insurance pays their $30,000 limit. Then, Maria's UIM coverage would kick in and pay the remaining $220,000 of her medical bills and lost wages. Her financial life is saved. The shield holds. When you're selecting your policy, you'll typically see UM/UIM limits that match your own liability limits. If you choose 100/300/100 for your liability, you should choose the same for your UM/UIM. The cost to add this robust protection is often shockingly small. For many people, it's just a few extra dollars a month. There is no other coverage on your policy that provides more value and more critical protection for the price. It is the single most important decision you will make after choosing your liability limits. It's the difference between a horrible accident being a bump in the road you recover from, or a financial cliff you get pushed over. So you've protected yourself from the financial fallout of other drivers, both the uninsured and the underinsured. But what about protecting your car from, well, everything else? From your own mistakes, from hail, from theft, from a deer jumping out on a country road? That's where the final crucial pieces of the puzzle, collision and comprehensive coverage, come into play, and they protect your investment in ways that liability and UM/UIM simply can't. Let's break them down because this is where a huge chunk of your premium goes, and it's also where you can find significant savings by making smart choices. First up, collision coverage. The name is pretty self-explanatory. This is the coverage that pays to repair or replace your car if it's damaged in a collision with another object. That object is usually another car, but it could also be a pole, a fence, a guardrail, or a fire hydrant. The key thing to remember about collision is that it pays out regardless of who is at fault. Let's paint a picture. You're backing out of a tight parking spot at your local H-E-B. You check your mirrors, you check your camera, but you misjudge the distance to a concrete pillar. Crunch. You get out and see a nasty dent and a broken taillight on your own car. Because you hit a stationary object, you are 100% at fault. Your liability coverage won't do a thing for you here. It only pays for damage you cause to others. Your uninsured motorist coverage is irrelevant. This is where collision coverage becomes your hero. You file a claim, and after you pay your deductible, your insurance company pays for the rest of the repairs to get your car back to its pre-accident condition. Or consider a different scenario. Someone runs a red light and T-bones you. It's clearly their fault, but their insurance company is dragging its feet, arguing the details, or maybe the other driver is just being difficult. You need your car fixed now, not in 3 months when the lawyers finish arguing. With collision coverage, you don't have to wait. You can file the claim with your own insurance company. They'll pay to get your car fixed right away, minus your deductible, and then they will go after the other driver's insurance company to get their money back. A process called subrogation. If they're successful in getting their money back, they will also recover your deductible and refund it to you. It's a way to expedite your own repairs and let your insurance company handle the fight. Now let's talk about that word I just mentioned twice, deductible. This is one of the most important concepts to understand when it comes to collision and comprehensive. A deductible is the amount of money you have to pay out of pocket for a claim before your insurance coverage kicks in. Think of it as your share of the repair cost. Deductibles for collision coverage typically range from $250 to $1,000, or even higher. So let's go back to that H-E-B parking lot crunch. Let's say the repair bill is $2,000 and you have a $500 collision deductible. You would pay the first $500 to the body shop, and your insurance company would pay the remaining $1,500. If the damage was only $400, you wouldn't file a claim at all, because the cost of repair is less than your deductible. Here's the critical link to affordability. The higher your deductible, the lower your premium will be. By agreeing to take on more financial risk yourself in the event of a claim, a higher deductible, the insurance company rewards you with a lower price for the coverage. Choosing a $1,000 deductible instead of a $250 one can save you a significant amount of money on your 6-month premium. The trick is to choose a deductible that you can comfortably afford to pay on a moment's notice. Don't pick a $2,000 deductible to save money if you don't have $2,000 available in a savings account. Okay, so that's collision. It covers damage from, well, collisions. But what about all the other bad things that can happen to a car? What about the infamous Texas hail that can make a car look like a golf ball? What if you wake up one morning and your car is just gone? Stolen from your driveway? What about the rising floodwaters we see all too often during hurricane season? This is where comprehensive coverage steps in. It's sometimes called other than collision coverage, and that's a perfect description. It covers damage to your car from a whole host of events that are not a collision. This is your protection against the random, unpredictable chaos of the world. Comprehensive covers things like theft and vandalism, fire, damage from falling objects like a tree branch in a storm, damage from hitting an animal, and in Texas that's a very real risk, whether it's a deer on a hill country road or a wild hog somewhere in East Texas. And crucially for Texans, it covers weather-related damage, hail and flooding. Like collision, comprehensive coverage also has a deductible, which works the exact same way. And just like with collision, you can lower your premium by choosing a higher deductible. Often, you can choose different deductibles for each coverage. For example, you might have a $1,000 deductible for collision, but a lower $500 deductible for comprehensive, since things like hail or a cracked windshield are often more common and less a matter of your driving skill. So, the big question is, do you actually need these two coverages? Legally, the state of Texas does not require you to carry collision or comprehensive coverage. The state only cares that you can pay for the damage you cause to others. But, and this is a huge but, if you have a loan on your car or if you are leasing it, your lender will almost certainly require you to have both. Why? Because until you pay off that loan, the bank or finance company is the legal owner of the vehicle. They have a financial interest in it, and they require you to carry collision and comprehensive to protect their investment from being damaged or destroyed. If you total a car you still owe $15,000 on, the lender wants to make sure there's an insurance policy to pay off that loan. But what if you own your car free and clear? What if you have the title in your hand? Well, then the decision is entirely up to you. And this is where you need to be a savvy consumer. To decide, you need to ask yourself two simple questions. Question 1. What is my car worth? Not what you paid for it, not what you think it's worth, but its actual cash value or ACV. You can get a good estimate from sites like Kelley Blue Book or NADA Guides. Question 2. Can I afford to replace my car out of my own pocket if it gets totaled tomorrow? Here's a common rule of thumb many financial experts use. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's actual cash value, it might be time to consider dropping it. Let's do the math. Say you have a 10-year-old car worth about $4,000. You check your policy and see that you're paying $600 per year just for the collision and comprehensive portion. That's 15% of the car's value. In this case, you might be better off dropping the coverage, taking that $600 you're saving, and putting it into a dedicated car replacement savings fund. Over a few years, you could save enough to buy a similar used car if yours is destroyed. On the other hand, if you drive a $30,000 SUV, and you don't have 30 grand sitting in the bank, carrying full coverage is a no-brainer. Paying a few hundred extra dollars a year is a small price for the peace of mind of knowing that a single bad day, a hailstorm, a hit and run, won't lead to a devastating financial crisis. It's about weighing the premium cost against your personal financial risk and your peace of mind. So, to recap, collision and comprehensive are the coverages that protect your vehicle. Collision covers damage from accidents, and comprehensive covers damage from almost everything else like theft, weather, and animals. They both have deductibles, and raising your deductible is a primary way to lower your premium. Whether you need them depends on if you have a loan and, if you don't, on your car's value and your own financial situation. By understanding these coverages, you can now build a policy that's perfectly tailored to your needs. Not just the state's minimums, but a real shield that protects you, your passengers, your assets, and your vehicle. We've now covered every major piece of a standard Texas auto policy. We've built it from the ground up. So now you have your ideal policy sketched out. You know the liability limits that make you feel secure. You've decided on your deductible for collision and comprehensive, and you've picked the optional coverages like personal injury protection and uninsured motorists that give you that extra peace of mind. This right here is the most important step because you can't find a good price on something if you don't know what you're buying. Shopping for insurance without knowing your numbers is like going to the grocery store hungry without a list. You'll end up with a cart full of things you don't need and a bill that makes your eyes water. Now, we pivot from building the policy to finding the price. This is where the hunt begins. Your mission is to find the company that offers this exact, custom-built policy for the lowest possible premium. Let's break down the strategy into actionable steps. First, you need to get organized. Before you make a single call or click a single link, gather your documents. You'll need the driver's license number for every driver in your household. You'll need the vehicle identification number, or VIN, for every car you want to insure. You can find this on your current insurance card, your vehicle registration, or on the driver's side dashboard right where it meets the windshield. You'll also want a copy of your current policy's declaration page. This is your cheat sheet. It shows all your current coverages and is the perfect baseline for your new quotes. Having this information ready turns a frustrating hour-long ordeal into a smooth 10-minute process. Next, you need to decide how you're going to shop. In Texas, you essentially have 3 main paths, and the best one for you depends on your personality and how much time you have. Path 1 is going direct to the insurer. This means you go straight to the websites of companies like Geico, Progressive, or USAA if you're eligible. You fill out their online forms one by one and get a quote directly from them. The upside is you're in total control. The downside is that it's incredibly time-consuming. To get a true sense of the market, you need to fill out 5, 6, maybe even 10 different online applications, answering the same questions over and over again. Path 2 is working with a captive agent. This is your local State Farm, Allstate, or Farmers agent. These agents work exclusively for one company. The benefit here is a personal relationship. They know their company's products inside and out and can be a great advocate for you. Within the confines of that one company, the limitation is obvious. They can only sell you one brand. If their company's rates for a driver like you in your zip code are high that year, they can't offer you a better deal from a competitor. This brings us to Path 3, which for many people is the ultimate time saver and money saver. Working with an independent insurance agent or broker. Unlike captive agents, independent agents represent multiple insurance companies. They work for you, not the insurance company. You give them your information once and they go out and shop the market on your behalf, bringing back quotes from numerous carriers, from national giants to smaller, regional Texas-based insurers you may have never even heard of. They can spot the company that's most competitive for your specific situation right now. This is their entire job. Whichever path you choose, the single most critical rule is to compare apples to apples. This is where most people get tripped up. You get a quote from Company A that's $200 cheaper than Company B, and you think you found a winner. But when you look closer, you realize Company A quoted you the bare minimum state liability of 30/60/25, while Company B quoted you the robust 100/300/100 protection you actually wanted. That cheaper quote isn't a better deal. It's just less insurance. Make sure every single quote you compare has the exact same liability limits, the exact same deductibles, and the exact same optional coverages. Only then can you truly know which company is offering you the best price. Once you're getting those apples-to-apples quotes, it's time to unleash the secret weapon in your affordability arsenal: discounts. Never, ever assume a company is automatically giving you every discount you qualify for. You need to ask. You need to be your own advocate. Let's run through a checklist. First, the big one, the multi-policy or bundling discount. If you have a homeowner's or renter's policy, get a quote from that same company for your auto insurance. This is often the single largest discount available, sometimes saving you up to 25%. Next, driver-based discounts. Are there any students on your policy with the B average or better? That's a good student discount. Have you taken a state-approved defensive driving course recently? That's a discount. In Texas, this can be a powerful way to not only dismiss a ticket, but also lower your rates for up to 3 years. Ask about it. Are you a safe driver with no accidents or tickets in the last 3 to 5 years? That's a safe driver discount. Think about technology. Many carriers now offer telematics programs, where you use a smartphone app or a small plug-in device that monitors your driving habits. Things like hard braking, rapid acceleration, and time of day you drive. If you're a safe, conscientious driver, this can lead to significant savings. But be honest with yourself. If you have a lead foot, it could potentially work against you. Then there are vehicle-based discounts. Does your car have anti-lock brakes, airbags, and automatic seat belts? Those are passive restraint and safety feature discounts. Does it have an anti-theft system like an alarm or a tracking device? That's another discount. And don't forget the simple policy management discounts. Can you pay your entire 6-month premium up front? That's a paid-in-full discount that avoids monthly installment fees. Are you willing to sign up for automatic payments from your bank account and receive your documents electronically? That's an auto-pay and paperless discount. Finally, there's the affinity discount. This is one people almost always forget to ask about. Are you a member of a certain professional organization, an alumni association, a credit union, or the military? Many insurance companies have partnerships with these groups that provide special, lower rates to their members. You might be sitting on a discount right now and not even know it. Now let's talk about the elephant in the room. The one factor that can have a massive impact on your Texas auto insurance rates that has nothing to do with your driving record: your credit score. In Texas, insurers are legally allowed to use a credit-based insurance score to help determine your premium. Now, this isn't the same as the FICO score a bank uses for a loan, but it's based on similar information from your credit report. The data, according to the insurance industry, shows a strong correlation between how a person manages their financial responsibilities and how likely they are to file a claim. You don't have to like it, but you have to be aware of it. What this means for you is that one of the best long-term strategies for lowering your auto insurance is to improve your credit health. Pay your bills on time, keep your credit card balances low, and check your credit report for errors at least once a year. Disputing and fixing an error on your report could lead to a direct and immediate drop in your insurance premium. It's a powerful lever you can pull that most people ignore. Finally, the last and perhaps most important piece of advice: make shopping for car insurance an annual ritual. Set a reminder on your calendar for 1 month before your policy renews every single year. Loyalty is a wonderful trait, but in the insurance industry it rarely pays off. The company that gave you the best rate last year is not guaranteed to have the best rate this year. Companies are constantly changing their rates and their appetite for risk in different areas. Your life also changes. Maybe you have a shorter commute, you paid off your car, or a speeding ticket just fell off your record. All of these things can dramatically change your premium. Don't let your policy auto-renew without a fight. Taking just 1 or 2 hours once a year to run through these steps, gathering your info, getting 3 to 5 competing quotes, and asking about every single discount can save you hundreds if not thousands of dollars over time. You are now armed with everything you need. You know how to build a policy that truly protects you, and you have a strategic step-by-step game plan for finding that policy at the best possible price. You are no longer just a price taker. You are an educated consumer, ready to take control of your financial protection. The power has shifted from the insurance companies to you. Now go out there and find the deal you deserve.